Hey, happy Monday. If you are trying to figure out right now whether it's the right time to buy, this past week actually told us a lot. So what I'm going to do is break down the key reports from last week, why they matter to you, and whether they pushed rates up or down. Here's the rates where they sit right now. First of all, FHA and VA are sitting at 5.625, and conventional and jumbo are at 6.25. Now, all these rates are shown with 1 point, assuming a 780 FICO score, and with jumbo and conventional 25% down. Now, let's get into the data from last week. The biggest driver of mortgage rates right now is inflation, and one of the biggest drivers of inflation is unemployment. So when we look at the job data, what we're really asking is the economy staying strong or is it slowing down? Because that's what ultimately moves rates. So let's go back to last Tuesday. We got ADP employment report. This showed that jobs are still being added, which is great. But if people are working and earning income, they spend money. Spending money keeps inflation elevated. And if inflation is what keeps mortgage rates, or inflation is what keeps mortgage rates higher. So this report was slightly negative for interest rates. It didn't spike them, but it didn't help them come down either. Now, moving to Wednesday, we had mortgage applications. This is a sneaky one. This is really important, especially if you're thinking about buying. This report tells us how many people are actively applying for mortgage loans. In other words, how many buyers are actually in the market right now? This is the key to your competition. So what we're seeing is that applications are still coming in. They're not exploding, but they're not disappearing either. It tells us demand is still there. So even though things feel slower, rates are higher, you're not alone in this market. And even if rates drop a little, just a little, that demand can quickly increase. For example, on a $600,000 home, even a small move in rates can change your monthly payment by a few $100s. This doesn't directly move the rates, but it tells you what competition might look like. Last Thursday, we got jobless claims. This tells us how many people are filing for unemployment. This came in relatively low, which is a good thing. Low layoffs mean the economy is still holding up. And again, a stable labor market keeps pressure on inflation. So this was slightly negative for interest rates, but good for everybody, right? Now, the other major factor last week had nothing to do with the reports. We talked about it last week as well. It's the global tension, specifically around Iran and oil. When oil prices rise, it increases inflation expectation. And when inflation expectations rise, mortgage rates tend to rise as well. So higher oil equals upward pressure on interest rates. We had a great start to rates last week, but ultimately this uncertainty around oil pushed rates back up. Now, what does that mean for you? Well, if you're a buyer, demand clearly hasn't disappeared. Mortgage applications showed that to us clearly. Buyers are still active. They're just a little bit more cautious. This creates a window where there's less competition, and we've seen in the past couple of weeks. But if your rates improve, that can quickly change. And if you're thinking about refinancing, this is not a wait and hope market. This is set a target and be ready market, because when rates move, we now know they can move quickly and they move fast. Now, looking ahead, this is a big week. And each report we have this week is going to help answer the same question. Is the economy slowing or is it not? So tomorrow, we get JOLTS reports, which measures job openings. If job openings are dropping, that suggests the economy is slowing, which could help interest rates. If they stay high, that keeps pressure on interest rates. Tomorrow, we also get Case-Shiller, which tracks home prices. Rising prices could tell us strong demand, but also can tell us about inflationary. On Wednesday, we get ADP and retail sales. Now, retail sales is important because it tells us if consumers are spending. Higher spending, higher inflationary reports. We'll be watching these rates to just kind of monitor what's going on until Friday when we get BLS jobs reports. This is the report that will likely set the tone. The data of the economy, this shows us if the economy is slowing, if rates will improve, or if it's getting stronger, that could elevate rates higher. You're also probably hearing a lot right now about waiting for rates to drop, but the reality is rates don't move in a straight line. We've already seen how quickly things can shift. So right now in this market is not, let's wait for rates to drop. This market is, let's see where rates are and have an appropriate strategy in place to help my family maximize on where we're at. Look, every interest rate has a season. Higher rates, less competition, more negotiating power. As rates decline, as we started to see in the last couple months, less competition, less negotiation power, more offers. So the important place is not waiting for rates. It's waiting for the right house, but how you're going to capitalize off this is having the right strategy for the season. You don't want to overpay, and you certainly don't want to underbid. Let's get a strategy session. Let's put a plan in place for you and your family. And if you're thinking about refinancing, one lesson you should learn from the last 2 weeks is that when rates were 5.625, but you just wanted to wait for an 1/8% lower, which some of you did, you see how quickly that can turn. And that's why we have and lose that rate. And that's why we have that target rate. The target rate is the rate that you set yourself that once it hits, if you miss it, you're going to regret it. And my job is to ensure that once that rate hits there, I will reach out to you and we will get you locked and moving forward to protect you and your family from any unnecessary or from missing out again. Paul Obrantz, Clear to Close Brokers. I hope you have a wonderful week.